there's been interesting things again going in our market. The volatility still is playing its little dirty game right now. So let's talk about what the hell is going on once again in our real estate market, in our lending world.
Let's do it, Cash. Let's do it.
All right. Yeah, what's happening out there, man? Rates kind of kicked up a little bit, huh?
Yep. So as I'm speaking to you today, and I just priced my rates today, I price it every day to see where our par rate is. As you remember from our last discussion, the day before the Fed made their announcement,
right,
our par rate was around 5.6, 5.7%.
That was getting pretty sexy at 5.6. We like that.
That was exactly, to quote you, very sexy. But as of today, close of business, my par rate is closer to 6.5%. That's almost a 1%, let's say a 0.9, 0.8 to 0.9% increase in the par rate.
Yeah.
Even though the Fed dropped interest rates a half a point, which is a quarter point more than that the market already had priced in.
Yeah.
What that should reinforce is Wall Street is always, because Wall Street's always trying to stay one step ahead.
Right.
The simplest way I could put this, and this what recently happened is proof of this. What the Fed is going to do, and what Wall Street perceives the Fed is going to do in the future,
right,
actually has more impact than what they've already done.
That's what you were telling me earlier, and I think that's fascinating. What he is going to do,
what they are going to do, what the Federal Open Market Committee. I mean, sorry, I didn't mean to interrupt you, but Jay Powell, is just the head of the committee. It's really the whole committee that makes the decision. But go ahead.
He's got to have people he can blame stuff on. I know, I get it, man. It's not just him, right?
He's got people he can blame stuff on, so we can all blame him.
There we go. Exactly. So, but what he has to say is going to potentially happen. His speculations, I guess, or what he's leading people to believe is going to happen, has more power than what actually is happening. Is that right? Is that what you're saying? Basically,
for the most part, yes. I'll give you a perfect example. The day before the Fed cut rates a half a point, the market had priced in a quarter point, and there was a lot of excitement about the fact that they could actually drop it a half a point.
Yeah.
Well, the Fed actually dropped rates a half a point on September 18th. But in the commentary that followed, along with subsequent comments by the Federal Reserve Chair and other members of the Federal Open Market Committee, the general bias based on data, based on economic data, based on the GDP, based on inflation numbers, based on the jobs market, et cetera, based on consumer confidence, based on consumer spending, their bias has been more towards, okay, we cut rates a half a point, but we think we might want to leave them where they are for a longer period of time before we cut them again.
Gotcha.
As opposed to what Wall Street was anticipating and excited about was continued rate cuts. So now that Wall Street has figured out, okay, maybe the bias isn't towards continued rate cuts. Maybe the bias is more towards leaving things where we are for a little while until inflation cools off more, until the economy slows down more.
Right.
And that sentiment has now actually had an adverse effect on rates, where you stand back and you take a snapshot and it's like, okay, the Fed cut rates a half point, which is a quarter point more than it was anticipated. Mm-hmm. And our par rate has gone up about almost 1%. It's gone up about 0.75%.
That's pretty strong.
From the day before the Fed actually did what they did. So that doesn't really make any sense, but it tells you all you need to know about the market's bias, that what the Fed is going to do, what the market thinks the Federal Reserve is going to do, has a much stronger impact on the market and on rates than what the Fed has already done. Case in point, what we just experienced between September 18th and today.
Very interesting, Dave. Very interesting. Thanks for bringing that to our attention. So again, with what's going on in the real estate markets out there, I'm still seeing the same thing as our last chat that we had last week. Still choppy. You know, that's the word I like to use for this market. Again, I'm working, licensed and working real estate in Idaho, the Boise Treasure Valley, Idaho area, and also Santa Clarita, California, basically, and also Las Vegas, Nevada, and masterminding with agents all across the country. So we're always listening to how things are working in different markets, and they're different in different markets. So we can't give a blanket answer for the whole country, right? But overall, right, it has slowed. Okay, the time of year, right, naturally. The interest rate volatility has really played on some people out there, you know? So they really need to be super knowledgeable and paying attention. If they're really looking at getting a home right now and trying to land the best interest rates to improve that affordability, they really got to be vigilant with this whole thing right now. Talk to your lender, talk to your agent, be on your toes, be ready to make a move, because rates were down to 5.62 for your par borrowers. And then here we are right back up to 6.5. there was a small
Well,
window of opportunity where you could have jumped on that, right? But you're
and to
not paying
your
attention.
point, one of the things that might contribute to the slowing is, human beings, being human beings, can get disillusioned. If they're getting excited about, hey, 6% became 5.5% on its way to 5%.
Right.
And all of a sudden it's like 6% became 5.5% and now it's back to 6 point something percent.
Right. Right.
A lot of people can get disillusioned by that. A lot of people can get set aside by that. And this is a good reminder that when it comes to buying a home, marry the house, date the rate.
Right. Right.
You get your price, you lock in your price.
Right.
Even though it's a fixed rate, any interest rate you get now is a temporary animal. And it's temporary until rates eventually coming down is not an if. It's a when.
When and how much.
And people are slightly disillusioned, and Wall Street is slightly disillusioned now because the when isn't as soon as they might want it to be.
Right.
But make no mistake, there is a when.
Yeah.
And it may not be as soon as Wall Street might want it, but the probability of a continued drop or a decrease in interest rates over the next 6 to 12 to 18 months is significantly higher than the probability of an increase in those rates.
Right, exactly. And people need to employ these tactics like floating the rate. We talked about this a couple times before. This is a very valuable tool that you could use in your arsenal when buying a home and the rates are not where you want them and the volatility in the market is still there, which probably the next couple of weeks I feel it will still be there going through this whole election. My thought is, and my feeling after the election, things will probably calm down a little bit and maybe that volatility will kind of find a place. Maybe. Again, I hate to say it, but gosh, it's concerning, but I think at least I feel that after the election, things might calm down a little bit anyways. I'm hoping so. But right now, if you're concerned about the rates today, but you want to get into the market, you want to go for it, and you're understanding what Dave is saying right now, that listen, date the rate, right? Marry the house, date the rate. We've heard people say that. So true, though. It is so very true. You're not marrying that interest rate. That is what you need to be able to afford now.
An interest rate is, by and large, a temporary thing. Even though it may be a 30-year fixed rate interest rate,
right.
I can tell you the number of people who keep their loan more than 3 to 4 years is a very, very small, much smaller percentage than you think. Unless somebody's locked in a 2 or a 3 or a 3.5% interest rate,
right.
Most people keep an interest rate, even on a 30-year fixed loan. The average time is about 3 to 4 years. Most people refinance about every 3 to 4 years for some reason or the other. Again, we went through a period of 2.5 to 3.5% rates. People have those rates are a lot less likely to fall into that. And of course, if a lot of people did that, then that may have an effect on the longer term mapping of the number of people that actually refinance. But if you're talking about on an average market, not one where we've seen lows in the 2s and 3s.
Right.
People typically refinance every 3 to 4 years.
Right. And again, those historically low interest rates was through COVID. And that if people are waiting around for that to come back, you might be waiting around a very long time. A very long time. Give it up.
To piggyback on something else you said about the election, and we don't need to go into a long discussion about this, but it's also possible that the outcome of the election may also have a notable impact on the markets. Regardless of whether it should or not.
Right.
As you might remember in 2016, for whatever reasons, when Trump won the election, the stock market shot up. There was a significant increase in the stock market, which again has everything to do with Wall Street's perception of things. I mean, because subsequent to that, it dropped off, and now it's reached new highs again, right? So my point in saying that was, very simply put, the outcome of the election may in itself have some impact on the markets.
I'm with you on that 100%. I believe it for sure. We're probably not going to get into the conversation of who is going to win and to have that effect, but let's see how it all plays out, right?
No, I just meant more on a very generic level, if you will.
Right. No,
on a nonpartisan level.
Right, on a nonpartisan generic level. Yes,
who wins or loses, or how the outcome of the election. Yeah. And I don't mean just the top of the ticket.
Yeah.
I mean the outcome of the election from the top of the ticket all the way down the ballot.
Gotcha. Okay.
Those outcomes and what party may or may not have power very often has something to do with the direction that the markets go.
Agreed, 100%. So, but
and I just meant that as a piggyback to what you said. Is you said, I think things might change after the election, and you may be very well right on that.
Yeah.
But also the outcome of the election may have something to do with how those things change.
Mark my words right now. I think I'm pretty darn right about that one. That one I've got a really good, strong feeling on. Sounds like you might have a strong feeling on that as well. But let's see how it plays out. But in the meantime, when we have buyers right now wanting to go forward to make the move because they have to or they really want to, whatever the reason is, and the interest rate volatility bouncing all around the place, the market, the concerns, the scares out there, people are worried about the election for some reason. It's always like, I'm going to wait for the election and I'll wait for the election. But nothing's really going to change that much. But there could be some small changes. But, the world is still going to go on, still going to move forward, right? One way or the other. So anyways, taking that out of the equation, if you need to buy a home, talk to your lender about floating rates. Float the rate. This is a big deal. This is a big tool that you could use in your arsenal to, play that float game. And we could absolutely explain to you how that works, and keep yourself careful. Right?
If I may add something to what you just said as a piggyback.
Yeah, sure.
In a market where rates are trending specifically up, specifically like they did from early 22 all the way through late last year.
Right.
You're typically going to want to try to lock in sooner rather than later because the probability is higher that the rate will go up by the time you're ready to close.
Right.
In a market like this, where rates have typically been trending in the downward direction, let's say with the exception of September 18th to today, in a market where rates are typically trending down because inflation's cooling, the job market isn't what it was 6 to 8 months ago, all of the factors, if the probability of rates coming down is greater than the probability of them going up, then you stand to gain by floating.
Right. Absolutely. 100%.
Not to mention,
all relative, yes.
When you go to lock in your interest rate, there's a 60-day lock, there's a 45-day lock, there's a 30-day lock, and there's a 15-day lock.
Right.
The shorter you lock in for, the better your price is.
Right.
As an example, if you lock in for 60 days versus locking in for 15 days, that could make as much of a difference as an eighth to even 0.25%, depending on the investor and depending on the market, in your interest rate. So, especially in a downward trending market for rates, it makes much more sense to consider floating than it does to lock in at the onset.
100%.
Typically, when you lock, it's not a case that you can lock and float down if it comes down.
Yeah.
If you lock, you lock, and you might get a small benefit if it drops significantly.
Right.
Whereas if you're floating and you lock in once it's dropped towards the close, you get the full benefit of the lock.
Gotcha. Copy that. So
does that help?
Yeah, no, 100%. Let's go forward with about new construction sales out there. Have been picking up a little bit. They've been decent, right? Because the builders are offering so many incentives to the buyers right now with buy down rates or low interest rates right out of the gate. But know this, so that makes it very attractive, right? But understand this, that you could do that with resale properties too. There are lots of people out there selling their homes. When I say resale, meaning they're not brand new, but they're selling these homes. And they could offer those for you as well. If you have a good agent, they could negotiate that in the contract and get the seller to buy down those rates as well and match what the new construction is doing too. So please know that, you don't have to go to new construction just because they're offering lower interest rates right now. You could definitely negotiate and work something out with your resale properties too. Got a good lender, you got a good agent, always very helpful. So make sure you've got that in your back pocket too. Okay. So,
and to add to that, to Cash's point, if you're selling, if you're looking to buy a home and there's a certain cost, and I can certainly work through those numbers with you about what the cost would be to buy down the interest rate, how much permanently, how much temporarily, et cetera.
Right.
And whether it makes sense to do a permanent versus a temporary buy down, and how much bang you get for your buck on either case.
Right.
The cost of that buy down could very easily be built into the purchase price. It's not something that has to come out of your pocket.
Exactly. Yeah, 100%. And it's just unfortunate for a lot of buyers out there that don't know these things are available. And when I talk to people, I was referred to a buyer yesterday, and they want to build a home, right? I've had a lot of first-time home buyers or even second home buyers. They want to build a home. That's always the dream, and I get that. But then I've talked to them. Have you talked to a lender yet? No, not really. I've talked to a few things. I said, well, have you sat down and gone through the numbers? Have you put it on paper? Have you looked at everything? Hey, do you need a construction loan to build this house? Are you going to have enough cash to put down on the raw piece of property? Is it going to need septic tanks and wells and all these kind of things? You're going to have to put the utilities on this property, or are you going to get one with it? So sometimes they have no idea. They just want to buy a brand new piece of land and they want to build a house. I get it. The American dream, build your own home on your own property, 100%. But sometimes they look at that and they start looking at what's involved in the numbers and then the time that it's going to take, right? It takes a while to build your house. You buy the land, now you got to build the house. Hopefully you got a place to
Not to mention the cost of having to live somewhere else.
Right, exactly, because most people will need to sell their home to take the proceeds in order to start the whole process, right? To even buy the land, typically. Sometimes they have enough money saved, they could buy the land, get away with that, and then start the rest of the process. But you've got to sit down and talk to the lender. My whole point of that is you've got to talk to the lender. You've got to crunch the numbers. Look at everything. Look at your closing costs. Look at the current interest rate. How is that going to reflect in your monthly payments right now? You know, what is it going to cost? $5,000 a month? $4,000 a month? $3,000? We don't know, but you need to know. You need to know those answers so you're very comfortable going forward. And I always have this conversation with any buyers, anybody that's referred to me, or even my sellers that are selling because typically they need to buy something as well. So you've got to have those conversations. And sometimes you've got to have the hard conversation. You've got to really ask the questions. Have you thought about this? Have you done that? You know, have you looked at these things? And then put it all on paper, right? So, and I've referred people to you too, and I know you do a great job of going through that with them and making them understand, are you aware of these costs and these different things that a lot of people haven't even thought about?
Understood. Yeah. And thank you for that. And, you know, to your point, it's not just as simple as cash to close and monthly payment. There's a lot more, you know, there's a lot more information. There's a lot more data that needs to be considered that, to your point, a lot of people don't think about. And as you do as a realtor and as I endeavor to do as a lender, is to build a relationship where, aside from just getting the job done, we also present ourselves as a resource. So in addition to the core information that you need to get the job done, what other, what I call peripheral but necessary information is it necessary for the client to have so that they can make an overall sound decision?
Right. 100%. So, Dave, what do you think rates are going to do in the near future, in your opinion? I know that you don't have a crystal ball. None of us have a crystal ball. We've got people out there listening right now. What do you think is going to happen, in your opinion?
Well, what I think is going to happen, and the time frame may vary, and it may take a little bit longer than we might have originally thought, but I'm still of the mindset that over the next 6 to 12 to 18 months, we're going to see a drop in interest rates. I think that we will see long-term rates settle in the vicinity of about, let's say, somewhere in the vicinity of about 5 to 5.5%, 5% give or take. But in order for that to happen, the Federal Reserve needs to be comfortable with the fact that inflation is considerably closer to 2% and staying there. The Fed has to be confident that the jobs market isn't taking off, that the jobs market has cooled, that the job market is stable but not roaring out. Because all of that has to come down to, what are consumers spending? Are people making enough money to spend? Because the balance of what people are spending in the seesaw against what things cost is going to have everything to do with inflation. And the greatest threat to interest rates is inflation. So even if the job market was thriving, as long as inflation's in check, the Fed is comfortable keeping rates lower. Now, of course, if we get to a point where the jobs market is really suffering and the Fed is starting to anticipate that maybe we're actually in some form of a recession, then that might spur them to lower interest rates even further. But typically speaking, interest rates' worst arch enemy is inflation. And as well, typically speaking, what's good for the economy is bad for interest rates and vice versa.
Gotcha.
So if you notice in a situation where the economy is really struggling, where there are severe headwinds to the economy, that's when you'll see interest rates at their lowest.
Okay.
Now,
Wow.
I don't think we're heading into that at the moment, but what I do think is over the next 6 to 12 to 18 months, we will see an improvement in rate as inflation cools further, as the job market cools further, and as the Fed gets comfortable with the fact that people are spending less and prices are in check.
And it sounds like you think there might be a 5 in that rate where it gets to maybe even a low 5 to a mid 5, yes?
Yeah, I'm optimistic that they will settle around the 5% mark, give or take, which is about, well, we were about 0.5% off of that. We're about 1.5% off of that now. Mm-hmm. But again, a lot of what we're experiencing right now is Wall Street's anticipation of what's going to happen. I think as inflation continues to cool, as we get closer to the 2% target, and most importantly, the Fed indication that they are inclined more towards cut rates rather than leaving rates where they are longer, higher for longer.
Gotcha.
That will all have a positive impact on interest rates.
Okay, perfect. Yeah, I'm with you. I'm on the same page with you on that exactly. And listen, if you're out there thinking of buying right now, this is a good time. It's a little choppy out there, as I've been saying. There are some opportunities out there. There are some people that really want to move forward and get their home sold. It's a little sleepy right now. There is some decent activity that's not dead. Don't take me wrong. The market is still moving. Homes are selling every day. Just not some crazy wicked pace right now. So you're not going to have to battle against all kinds of multiple offers and that kind of thing. Although some houses that are coming new on the market, if they're priced very well and they're a desirable home in a nice location, they're going to move pretty quick. And you might run into that multiple offer scenario once again. But there is some opportunity out there for you right now. If you're looking to buy a home, I would not suggest waiting to see if the rates come down anymore. Buy the home now, secure your deal, get in there, get comfy, cozy, right? And then when those rates come down next year, as Dave and I are talking about, do a refi. Do a refi then. And talk to your lender about, hey, if I do lock something in now and I do refi within a year or so, let's talk. How's that going to look? What's it going to cost me? Maybe there can be something worked out there. So, Dave, applications and in your industry right now, are you seeing an uptick in applications, kind of the same, or has it lowered? On the scale of things of normality, what are you seeing with the applications right now?
In our personal world, and understand I've been doing this for a little over 32 years, so I'm grateful for what level of success we do enjoy. But in my world, we've seen a very slight uptick recently. More people interested and more people are coming out of the woodwork for refinances than might have been before.
Okay.
Even on the purchase front, I think there's an enthusiasm and anticipation and an excitement that the market may be moving in the right direction. But there are a lot of buyers and sellers who are looking at this saying, okay, and this reflects back to the conversation we had last time, that as interest rates continue to drop, there is a distinct possibility that a lot of the respectfully described interest rate prisoners who are sellers
yes,
might decide to let themselves out of prison, put their home on the market, sell, and buy another home.
Right.
Well, what that's going to do is, reflecting back to our conversation in supply and demand, and again, we've had sometimes, sort of opposing or conflicting views on this, but my view is, as the interest rate environment improves, we're going to see more homes come on the market. That's going to improve the supply, and that's very likely going to cause a situation where there might be a deflation in prices. Again, that all depends on the balance between how many homes are coming on the market and how many buyers are deciding that they want to jump in and buy at that time.
Right.
There is a lag between the number of homes coming on the market and the number of buyers that are jumping up to go jump on these new homes and this new inventory. Mm-hmm. Then you're going to see a continued improvement in home prices.
Right.
If on the flip side of the coin, as homes start to come on the market, the number of buyers that come in to buy are excessive and a larger number than the homes coming on the market, you won't see a decline in prices because, again, the demand will be greater than the supply. So what am I saying? I'm saying at the end of the day, it all comes back to that balance of supply and demand. Supply meaning how many new homes are coming on the market.
Right.
And the demand is based on interest rates, how aggressive are buyers being about going after that supply. And depending on how that balance plays out, will have everything to do whether home prices go up or come down.
All day long. I agree with you 100%. Supply and demand, it's always there. It's a law that it's not going to change. If I was to let this go and drop it, it's going to fall to the ground, right? Same thing with the supply and demand principles. It's going to stay the same thing, okay? Also, anybody out there that's thinking about crash, we've talked about this before, right? There is no big crash building up. I'm not seeing anything. I'm not seeing a big buildup of foreclosures or short sales or distressed properties. And you will get some agents out there and some YouTubers and all these type of people that are really trying to hook people in with that fear factor, right? And I think a lot of us have gotten pretty wise to that through the years. Well, that still happens though, and it'll still catch you off guard. You're looking at this and that. What's the market doing? Oh my God, the crash. They got the crazy look in the whole thing. But guess what? There's no big buildup of foreclosures and short sales. There's always foreclosures. There's always short sales. There's always probates. There's always NODs, notices of default going out. There's always that, never changes, and it fluctuates a little bit, but we don't have anything like 2008 building up, nothing close to it at all. So please, I just want to share that with you. I've heard people still asking about that, but I talk to people in that industry that work with banks and foreclosures and asset managers, and no, we're okay right now. We're okay. And the country, the United States, has the highest level of complete home ownership in our country we've ever had. 40% of homes out there are owned mortgage free. Okay? 40%. That was not like that. And Dave will tell you too, hey, since the crash, they've tightened up on lending a lot, right? How are you seeing that still today, Dave? Still some tight regulations and lots of boxes and things to check for a borrower to go forward, yes?
Yes. While it's loosened up slightly from how extremely tight it was immediately after the last correction,
right? Because it was crazy.
It's still much closer to that than what it was before,
right? Which is going to protect and keep us all out of trouble like that, right?
And just to add to your comment about fear, a very large portion of marketing, both on your social media as well as even regular media marketing, just regular television marketing. A lot of people use fear as an incentive. Do this before that. If you don't do this, this is going to happen.
Right.
And I will tell you that there are two places from which you can make a decision, whether it's in business, the purchase of a home, or what you're going to have for dinner. And there's two places you can make that decision from. One is from fear.
Writing this down, Dave. This sounds like some pretty serious stuff. All right,
well, one is from fear. The other is from confidence. And the number of times good decisions are made from a place of fear are incredibly small to none.
Interesting.
The number of times that decisions are made from a place of confidence, and those decisions have been good decisions, are incredibly larger number of choices. So my offering to people is, when you get panicked and you decide you want to make a decision, calm down and try to get yourself to a place of confidence before you make that decision. Because more often than not, decisions made out of fear are not good ones.
Right. And also
and I'm just saying that to piggyback on what you were saying about fear in marketing.
Yeah. And also be cautious of the paralysis from analysis or overanalyzing something. I've had other buyers out there that are waiting for years and years and years for the rates to come down more or the crash to happen, and then they're going to buy. But guess what? It hasn't happened, and they still are renting an apartment somewhere, some of them crappy apartments, and they're not going forward because they're analyzing everything, or they have an uncle that's telling them this or another uncle that's telling them that, and they're like, their hair's coming out of their head, and they're like, I don't know what to do. Sometimes you just have to look at some things, talk to some other people maybe, and just feel confident going forward. But if you keep listening to all these opinions of people that are really not in the trenches, and they're not professional, and that's not what they do, and they don't work from a place of with ethics, for clients that are going to be long-term, they're not in there to make a wham bam. We just want a deal tonight and that's it. No, we want clients for life. And in order to get that, to achieve that, you have to be straightforward with people, have the tough conversations, right?
And I think you and I have both experienced that in our careers, both together and separately. While we love and respect family and friends,
sure,
more often than not, they're a detriment when it comes to having professional advice. Family and friends are great for being your family and supporting you in that respect.
Right.
But when it comes to professional advice in business, I would offer respectfully that the family and the friends are not the professionals you want to rely on.
Right.
Unless your family or friend is a professional licensed in the field that you're looking for advice,
Right.
their family advice and their friend advice typically is not helpful.
Yeah.
It serves
100%.
but nothing more than to just confuse and
Right.
disorient you.
And I get
Rely
it,
on the
Dave.
professionals and leave your family and friends out of it.
Right. And I get it, because it's hard to find the right kind of person to trust when it comes to some of your largest purchases and moves that you're going to make in life. You got to, there's so many horror stories out there, right? And there really are. And we've seen them too. But, we've also cleaned up a lot of horror stories for people when it comes to lending or real estate, or whatever the case might be, that, we have to unravel some big messes sometimes and stitch it all back together. And that's fine. That's what we're here for, right? But I get it. It's so hard to put your trust, your faith in somebody that's talking to you about your money and your moves and how you're going to handle all this thing. But hopefully you just come across those right people in your life, and it will have a profound effect on the turnout of all of these things. Right, Dave?
Yes, sir.
Awesome. I'm glad we're on the same page once again with that. Although I love it when sometimes we're not on the same page, because that makes for some pretty interesting conversations. What fun is it to talk to somebody that you guys agree on everything, right? No, so I love that about you, man. You'll go at it. We'll throw punches sometimes, but I love that. So, hey, I wanted to tell everyone too that my amazing, beautiful wife is going to potentially be on our episode next week, and she is going to be talking about our renovations remorse that a lot of people have had as of late, because there's been a lot of people, as you said, doing HELOCs, taking money out of the equity of their home and remodeling and staying put. Maybe they've got that historical low interest rate and they're staying put. So, but some people, there's a lot to that too about renovating the home or remodeling the home. You got to sit down and kind of look at all the potential pitfalls of that and how you can smooth all that out. My wife's amazing with that. She could remodel a house herself. Blows my mind. It's a little emasculating at times when she could fix the sink or the disposal, and I haven't been able to fix it. But, God love her for that, right? So anyways, we're going to get her on, give you some opinions. She's got a great decorating background too, and interior design, and she can remodel the houses. And so she's going to be a very valuable source, and hopefully some people ask some questions. Next week she'll be on. And then we're also going to talk about what's going on in the markets, interest rates with Dave D'Souza, Cash McCallum. Next week, I hope you guys will join us.